The information in this episode is current as of the date recorded and is not intended as financial, tax, or legal advice. You should consult your tax, financial, and/or legal advisors before implementing any transactions and/or strategies concerning your finances.
All right, so as we kind of get started, we're looking at just the different pieces of retirement income and what does that entail. There's several different pieces of that puzzle. We'll start with Social Security. So Social Security is kind of the main source of retirement income that most people plan for. We know that we've paid into it while we're working and you're developing credits and kind of earning your benefit over time. So there's different points where you can take Social Security, the earliest being age 62. You can also what is known as full retirement age, which right now is about age 67. And you could also defer until age 70. Once you defer from full retirement age up to age 70, you're looking at about an 8% increase per year. And that kind of stops growing at age 70. So the big question that we get is, when should we take Social Security? Well, that answer is not going to be one size fits all. Because if you are still working at 62, it's not going to make sense to claim that yet. You can only earn about $23,000 of income if you are also claiming Social Security. So if you're still working past 62, you're going to just not take Social Security yet. But if you are retired at 62, do you need to take Social Security? Not necessarily. So you could, if you have enough income coming in from other sources, and you would not need to take from any type of invested resource, it would be more beneficial to delay the Social Security so you have a larger benefit over time. So that's something that when we're talking with people, we try to look at all of those parts of that scenario of when is the best time for you to take Social Security.
And to go off of that point, there's no crystal ball out there. So unless somebody in this room has a crystal ball for us to look at, we don't know when you're going to die. And when that comes to taking Social Security, that becomes very difficult to tell. So we want to consider your longevity as part of that process. Also, regarding that is when your spouse passes away, you can receive a higher benefit depending on which person has the higher Social Security benefit. So those are two things to be prepared for when taking Social Security. So many pensions offer spousal benefits as well. So if you're taking a pension, you could take a single life pay, meaning that as long as you're alive, you're going to get paid out through the pension. You could also get spousal protection through that as well. So usually there's 50%, 75%, or 100% spousal protection. With spousal protection, that can lower your income from that pension. So if you're a single person, there's no reason for you to get spousal protection because that's just going to lower your income. There's no point of that.
One thing also with Social Security and with pensions, those are typically a fixed income source. So the Social Security does offer what's known as a cost of living adjustment, or a COLA, as you know. So you do get a small increase year to year with your Social Security. Pensions, on the other hand, there's typically not much of an increase. Some of the state employees' pensions do have a small increase that they do year to year. It's usually kind of a fractional percentage for, say, teachers or New York State employees. But overall, so maybe you have the old Corning pension, that's going to be the same income month to month to month. So that's not going to be keeping up with inflation.
So, can you just go back? Thank you. So we also have annuities. Annuities as well as another fixed income source, typically. So you have your fixed annuity, fixed index annuity, and a variable annuity. So you might be thinking to yourself, well, fixed annuity and fixed index annuity sounds very similar. They're a little bit different. Fixed annuity, the best way to look at it, it's very similar to a CD. It's not a CD, but it's very similar, where you put the insurance company is giving you, excuse me, is giving you a fixed rate, say of 5% for 5 years. So similar to a CD, but it's just a little bit longer. Now, fixed index annuity is, again, they're offering you fixed rates, but you're also invest is not the right term, but you do choose sub accounts, which are kind of like investments, but they're not investments. And then you have your variable annuity. So your variable annuity is definitely more of an investment. Again, you're still invested in what's called sub accounts, and they have a bit more variability to it. So that's the word, variable. Those can increase. Now, between the three, you do get a guaranteed income in them. But the variable annuity, it does have the potential to increase because you do get market fluctuation with the variable annuity. Annuities have been around forever. I was actually doing research on this not too long ago, and they've actually been around since the Egyptian days, which I thought was kind of interesting. You could see on the pyramid walls, they're talking about annuities on there. And the idea of the annuity is you put money into the account, and now insurance companies are guaranteeing that, hey, we're going to pay you this amount throughout your life. Annuities as well, you could also elect for example, a single life payout option where it's only guaranteed for your life, or you can get spousal protection as well. They usually call it joint income. That lowers the income. So if it was single life, just for example, you get $2,000, but if you do a month, but if you do joint, it'd be like $1,500 a month. So those are little differences between those three annuities there.
So over these last three sources that we've really talked about, you have options of when you are going to take that. So you can project out what that income is going to be. And then you also have to consider, if you have a spouse, what does that mean for your spouse when you pass away? So with Social Security, you're both collecting, one of you passes, one of those Social Securities is going away. So that's something that you have to keep in mind of where is that replacement income coming from. Same with the pension elections. You get a one-time chance to choose that. So when you're filling out your retirement paperwork, and if you choose a single life annuity, when you pass away, that benefit is gone. That's why it's really important to take a look and evaluate what is that going to mean long term, and what kind of benefit do you want to leave to your spouse. And those are the only beneficiaries that can have access to those funds. You're not able to leave a pension to a child. So it's either yourself or your spouse for those. Okay. Now, employer plans and IRAs. These are different from the other sources because these are the truly invested assets. These are also where you are contributing to that. Your money is going into these on an annual basis. They do both have contribution limits of how much that you are able to put in there. With an additional benefit, if you're over age 50, you're able to contribute more to that. Often, employer plans do have a contribution from the employer, which is wonderful. So if they're able to match, it's usually about a 3 to 4%, but I've also seen where some employers do up to 6% as a match. So that's kind of what you would call, free money from your employer. These are tax deferred benefits if you choose to do the pre-tax. So what that means is you're able to contribute from your pay before paying any of that income tax. That provides a long-term tax deferred benefit. Now you are only able to take from that after age 59 and a half. If you have to withdraw any money prior to that from an employer plan or an IRA, you're also subject to that 10% penalty in addition to the income tax. So most of us, while we're working, we are in a higher tax bracket than we will be when we're in retirement. So that's the time to really take advantage of the tax deferred benefit to lower your taxable income with those deposits. Once you take that money out, that's when you'll pay the income tax of wherever you are in that bracket at that time. Also with these, since you are deferring the income tax that you're paying on those, there comes a point in time where the government says, okay, you've deferred this benefit long enough. Now you have to take this money out on an annual basis. And that's called the required minimum distribution. And that was originally set at age 70 and a half. Right now in 2026, it's age 73. And there's a life expectancy chart that the IRS uses to determine what was your balance on December 31st of the year before, and then they have a divisor factor that says, this is how much you have to take out of this account. And again, those are both individual. So you're putting that money in, that doesn't go to your spouse unless you leave it as beneficiary, but these are your individual retirement monies that you're saving on your own behalf. Other investments. So we've talked a lot about pensions, Social Security, IRAs. We can also look to contribute to other accounts. Maybe that would be a brokerage account, an individual brokerage account. You can contribute to that anytime in your life. You're going to have it invested into different stocks, bonds, ETFs, and you're able to take that money out whenever you would like. It's not connected to your retirement. You're not forced to take that money out at any age. It's a good way to, you could consider it an invested savings account. So the only thing that you would do for that is there is something called capital gains tax, and that's a much favorable form of tax that you pay. And that's basically paying the difference between when you buy something and when you sell something. Is there growth or is there loss? You can take the loss to offset your other income, which is nice. Or you also have the gains that basically just means you're making more money, so you just have to pay a more favorable tax on that growth. But you can have that for your whole life. There's no age requirements. You have to be 18 to open something like that. It's also where a lot of people may hold company stock, and that's just another great avenue to have income in retirement.
Yeah, and going on your point of company stock, very similar to what Amber just spoke upon. For people, for example, I think what's valuable here is for people that work at Corning. I was actually told a story the other day of somebody that had 90% of their net worth into Corning stock, company stock, and that's not a great way to do things here. It's okay to have company stock, but you want to be diversified while having company stock. So again, company stock, basically what Amber just spoke upon, but also to just be aware you don't want to have all your assets into one stock. That's now corn has been going up lately, which is great news, but it could have went the opposite direction, which would be bad for your estate. So we also have HSAs, health savings accounts, which are also known as triple tax advantage, meaning they go in pre-tax, can be tax-free withdrawals for qualified medical expenses, and they grow tax-free as well. This is really beneficial if you're paying for medical expenses. Now, one thing to know about HSAs are you have to stop contributing to an HSA 6 months before you turn 65. Well, not 6 months before you turn 65. 6 months before you go on to Medicare. So for most people, that is 65. You want it because once you're on Medicare, you can no longer contribute to an HSA, but you can use those HSA account value to pay for your Medicare premiums there.
HSAs are typically available when you have a high deductible health plan, and this is the way that they want you to save the money. You can either pay your high deductible out of there, or you can just let that continue to grow. Sometimes employers make their own contribution for you, and then you have family limits and single limits where you're able to contribute as well, between $4,000 and $8,000 depending on if you're single or family. And one benefit of HSAs is that if you continue to let that grow, once you're over the age of 65, if you needed to have another revenue to have income, you would be able to pull from that. For non-qualified medical, you would just be paying income tax on that. But if it's used for any qualified medical expense, it's completely tax-free.
So common questions to consider.
One of the big questions, when should I retire? That's never an easy question to answer because everyone's scenario is going to be different. It would be more important to consider before you retire what income sources will be available to me. What sources will be fixed income that I know I'm going to get, and then where does the rest of the money come from? And how much do I need to withdraw from my 401k at that time? Have I done enough savings while I'm working that I can supplement my fixed income by pulling from my invested assets.
And then how much money do I need per month now and in retirement? Well, and again, that's another question where it's very dependent on you as a person. So for retirement, I've seen people that just live off their Social Security and that's all they're living off of. And then I've seen people that are spending too much in retirement because they're giving money to their kids, they're going on vacations. The key is to find a balance between the two. So for somebody in this room, it could be $2,000 a month and you're good. So for somebody else in this room, it could be $6,000 a month. But the key at the end of the day is finding the correct balance for you so you can be fine in retirement and not have to go back to work. Nobody wants to go back to work in retirement. I'm not even there yet, and even I know that. So having this right boundaries and setting yourself in the right position in retirement is key things to do there.
It's important to do a good cash flow analysis of how much are you spending now, what expenses do you have pre-retirement, and what expenses do you expect to have when you do retire. Oftentimes, people's goal in retirement is to travel. Well, how much money does that mean for you? What does travel mean to you? And then we need to know how to budget that. Do you have enough right now? Are we ready to? What sacrifices can we make while we're working to make sure that we have a successful and happy retirement and we can still do the things that we want to do? Again, are my income sources covering my expenses? We really can't stress the cash flow analysis enough because that's the basis of all retirement planning. How much do we need? Where's the money coming from? What are our inflows? What are our outflows?
And then, will I need the cash for my required minimum distribution? And I'll combine this question too. Are QCDs right for me? So, people with IRAs that are taking RMDs from that IRA, you might not need that money because, like I said, there's some people that can just live off their combined $2,000 a month or more Social Security payment. So, what a great idea I like is two ideas actually. Is you could use that RMD and you could send that to, if you're charitably inclined, you can send that to a charitable that can lower your taxable income instead of having to pay taxes on that RMD. Another idea I like too is you do have to pay taxes on this, is sending that money to a Roth. If you're somebody that wants to take care of your children, putting that money into a Roth over years, is that money could get passed to your children tax free. And that sets them up really nice for the future.
But if you're going through retirement and your other income sources are covering your expenses, and then at age 73 and the government is saying you have to take this much money out, but if that's not something that you actually need for your everyday cash flow, as Spencer said, you can do a qualified charitable distribution. So you can give right to a charity like many people already do in their day-to-day. Another option as well you could take that money from the RMD because you have to take that, and you could find another investable asset that you could put that into, such as a brokerage account. So you continue to keep that money invested, but you're still taking out the required minimum that you have to take.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.